Hello and welcome to AI Market News by LM. Let's jump right in because we have a truly explosive set of developments unfolding in the financial world today. As seen in the provided information, two of the absolute heaviest hitters on the planet, SPACEX and OPENAI, are gearing up for public debuts that could completely rewrite the tech landscape. In this explainer, we're going to break down the sheer scale of these impending IPOs, dissect NVIDIA's latest jaw-dropping numbers, and look at how some massive macroeconomic shifts are impacting everything from the US equities market to major global currency pairs. $2 trillion. That is the astronomical scale of what we are dealing with today. SpaceX is targeting a valuation of over $2 trillion for what is shaping up to be the largest initial public offering in history. Just to put that into perspective for us, a debut of this magnitude would easily shatter the current record set by Saudi Aramco back in 2019. It's a staggering figure for the world's most valuable private company, and it really highlights just how aggressively capital is rushing toward aerospace and advanced technologies right now. But what's truly fascinating here is the financial reality operating behind that sky-high valuation. We finally have a clear glimpse into their books. For the first quarter of this year, SpaceX generated a very impressive $4.7 billion in revenue. However, that top-line growth isn't quite enough to outpace their immense spending on computing and launch infrastructure. We're talking specifically about the Starship project, which has already burned through roughly $15 billion. The end result? A hefty net quarterly loss of $4.28 billion. So how does this actually translate into the mechanics of the IPO? Well, the company plans to list on the NASDAQ under the ticker symbol SPX. And crucially, the filing reveals a super voting share structure featuring Class A and Class B shares. This is designed specifically to allow Elon Musk to maintain tight control over the company even after it goes public. Leading this monumental offering will be the heavyweights: Goldman Sachs, Morgan Stanley, and Bank of America.
But the AI IPO mania definitely doesn't stop at the edge of space. Various news commentary has been buzzing nonstop about OpenAI potentially filing for its own public debut later this year. This is a massive story, especially when we consider SoftBank's heavily concentrated 20% stake in the company. But the market might actually force investors to make a tough choice here, because OpenAI's primary rival, Anthropic, is also building incredible momentum in the private markets. It is setting up to be an absolute sprint to the public markets for the titans of artificial intelligence.
Moving on to Section 1, US Equity Market Overview, Riding the AI Wave. The crucial point for us to unpack here is how all of these multi-billion-dollar catalysts are trickling down to affect the broader US equity markets. Let's take a look. Looking at the underlying drivers of the CNN Fear and Greed Index, we can see exactly what's capturing investor attention. Alongside the massive SpaceX IPO filing, markets are digesting some major legislative and political developments. This includes discussions around a potential AI executive order from Donald Trump, as well as a recently passed House housing affordability bill aimed at softening the ban on institutional investors. These headlines are collectively keeping the overall market sentiment incredibly elevated. And we can see that bullish sentiment reflected right here in the current market levels. Despite futures initially pointing to a pretty flat open, the broader tech rally just continues to provide rock-solid support. We're seeing the S&P 500 bouncing back, currently sitting at the 7,452 level. Meanwhile, the Dow has crossed that massive 50,000 threshold, and the NASDAQ 100 is hovering near 29,373. The underlying strength in these equities right now is just undeniable. And speaking of underlying strength, we absolutely cannot discuss the US equity market without talking about NVIDIA. Based on the prepared resources, the dominant chipmaker for the AI revolution absolutely shattered expectations, yet again. Their core data center revenue, driven by insatiable hyperscale demand, surged an incredible 115% year over year. On top of that, they provided robust guidance for the upcoming quarter, anticipating a staggering $91 billion in revenue. To sweeten the deal even further, NVIDIA announced a massive new $80 billion share repurchase program. But what is truly fascinating to watch is that the market reaction in after-hours trading was actually kind of muted. Why? Well, when a company's stock has surged over 600% in a few years and sits at a multi-trillion-dollar valuation, the bar for a surprise is set incredibly high. Perfection was basically already baked into the price. Section 2, Macro Indicators and FOMC Minutes. Let's shift gears for a minute. While tech and AI equities are flying high, the macroeconomic reality paints a slightly more complicated picture. We need to focus our attention on the Federal Reserve and the broader economic indicators dictating global liquidity. As seen in the provided information, the newly released minutes from the latest Federal Open Market Committee meeting have crossed the wires. And honestly, they're revealing a much more hawkish stance than many market participants were hoping for. Policymakers are expressing deep concern over inflation remaining stubbornly high and are showing distinct hesitation regarding any near-term rate cuts. In fact, this quote from the minutes really says it all. A majority of officials noted that the central bank will likely need to consider raising rates if inflation stays above the 2% target. This is a huge reality check for the markets. It shows us that if inflation metrics like the CPI and PPI remain sticky, the Fed is perfectly willing to step in and apply even more tightening. Building on that, the minutes also revealed that many participants expressed a strong desire to remove the easing bias, which is essentially the underlying assumption that rates will eventually go down, from the Fed's official statement entirely. This implies a very deliberate shift in communication to push back rate cut expectations, explicitly signaling to us that the next move could indeed be a rate hike rather than a cut. So, what's driving this persistent fear of inflation? Well, Fed officials specifically highlighted geopolitical tensions, particularly the ongoing conflict in the Middle East, alongside the potential for increased tariffs. These factors are creating immense upward pressure on commodity prices, which was glaringly obvious when Brent crude oil temporarily spiked all the way up to $106 per barrel.
However, we did get a little bit of relief on this front today. Oil prices slumped slightly, and both U.S. equities and treasuries caught a bid following comments suggesting the U.S. is in the final stages of negotiations with Tehran to potentially end the conflict. This is a very fluid situation, so we will definitely have to watch carefully to see how this diplomatic effort unfolds.
Section 3, Global Currency Pairs Watch. The divergence in central bank policies, specifically the Fed's higher-for-longer stance versus what other central banks are doing, is creating some massive waves in major currency pairs. Looking at our key currency watch, we can see the US dollar maintaining its firm dominance. The euro to dollar pair is sitting at 1.1626, but the real story capturing the financial world's attention right now is the Japanese yen. The US dollar to yen pair is trading at 158.97, hovering right on the edge of a critical psychological and technical boundary.
And that brings us to the most critical question in the forex markets today. Will the Bank of Japan intervene at the 160 level? The yen has weakened significantly due to the massive yield differential between US treasuries and Japanese government bonds. As we inch closer to that 160 mark, currency traders are on incredibly high alert for any sudden, aggressive moves from Japanese authorities. Adding immense pressure on the Bank of Japan is the fact that domestic inflation is actually heating up. Japan's 10-year break-even inflation rate has now firmly crossed the BOJ's 2% target, recently hitting 2.3%. This suggests that market expectations for inflation in Japan are rising rapidly, essentially forcing the BOJ's hand toward tightening their monetary policy. And institutional money is positioning for exactly that scenario. RBC Blue Bay Asset Management noted that they are convinced the BOJ will hike rates in June. They've actually been building long yen positions, arguing that the 160 mark is an incredibly attractive level to buy yen, anticipating either a rate hike or direct government intervention to strengthen the currency.
Section 4, Upcoming Economic Schedule. As we wrap up our explainer on this historic week in the markets, we need to look ahead. With so many moving parts between mega-cap tech IPOs and shifting central bank policies, staying ahead of the data is more important than ever. We highly recommend keeping a close eye on the investing.com economic calendar to track crucial upcoming macro data drops, scheduled speeches from Federal Reserve officials, and global inflation prints. These data points will dictate the next major moves in both equities and currency pairs. So with inflation looking sticky and a $2 trillion space IPO looming on the horizon, the ultimate question for us is, which of these historic catalysts will break first?
This video is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech.
This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Thanks for watching. Don't forget to like and subscribe.